is here today to talk to us about Red Rock Resources' investment portfolio. So, Andrew, what do you have? What's going on?
Yeah, well, when we talk about the investment portfolio, it's really, we're talking about our cash resources or potential cash resources. And I think it's really important that Red Rock has something in its back pocket. In the old days of the accepting houses, for one of which I worked back in the 1970s, they used to have inner reserves. They had their published reserves, and then they had secret reserves, and they had their profits, and then they had transfers in and out of inner reserves in order to smooth things. Now, they can't do that anymore, and we certainly can't do it, but we are aware that the cyclicalities of the financial markets are as nothing compared with the cyclicalities of the mining markets. We've seen in our time, just in the last few years, oil go up to well over $100, 120, come down to 26 again, and now go up to 40 or 50. We've seen iron ore go from 20 up to 180, and then come back to 20 plus, and now back above 100, just in a few years. And you look at the nickel. Nickel went up in 2004, earlier than other metals, a year earlier, because of Chinese demand. It went up very sharply and then came down very quickly as a result of new technologies being introduced, and is now maybe going up again. Copper too. So with all this cyclicality and the fact that on top of that, we are listed in markets that like AIM, which are acutely influenced by liquidity conditions in the economy generally. So AIM, to some extent, suffers from the malaise of a lot of smaller markets, so not to the extent of some of them, I have to say, which is that when times are good, money is very abundant. But when money is tighter, liquidity seems to disappear completely. So a company like us is not going to get into trouble because it doesn't make profits, because at the exploration stage, we probably don't make profits. It isn't going to get in trouble because it doesn't find things immediately. It's going to get into trouble if it does, because it runs out of money. And so far, our experience from 2005 has shown us that we need to keep bigger reserves to make sure we can get through those periods without running out of money. In 2010-11, we had our most expensive drill program ever, which was taking place in the rather inhospitable climes of Greenland. And our partner was not able to meet their spending commitment. And we had to decide, do we walk away without a result, or do we carry on and get a result and bear some of their costs and come to arrangements with them? We did the latter. And in retrospect, it looks as if it was probably a wrong decision, because we went into the decline in markets post-2010 with debt rather than cash. And we certainly, therefore, after 4 or 5 years of trying to get through that, we're not going to make that mistake again. So what we have is, well, some of these assets are actually very long-term. They don't represent positive decisions to invest. What they represent is progressive stages through which we crystallize the value of our mining interests. So, for example, we had tenements that we put into joint venture, and that joint venture then went into a listed company, Jupiter, to which we had previously sold assets in exchange for shares, and we ended up with a royalty and with shares. And some of those shares we still have to this day, and our shares in Jupiter are worth several $1 million, because it's a company with a valuation between 500 million and $1 billion Australian dollars, listed on the ASX. And because it produces phenomenal cash flow, the return on equity and return on assets over the last 4 or 5 years is somewhere in the region of 27, 28% compound. We think the company is very undervalued, but it's also a great thing to hold in the portfolio, because it gives us not just that reserve of highly liquid shares that we could sell, but it also gives us an income, even at times when the manganese market is low, because as probably the lowest or one of the lowest cost producers, Jupiter can make money even when the manganese price is low. And they've proven that. At the moment, manganese price kind of in the middle, doing quite reasonably. Long-term prospects pretty good. So anyway, we have that. That's a potential source of liquidity if we want it to be. The iron ore assets in Jupiter, that again, they came from us. We have a royalty of one of them. They're going to be floated out in a new listing called Juno, and that's happening fairly soon. I think it's a good time to be floating out an iron ore company, and with the market being quite good for iron ore, there's a prospect they could bring this into production, and if they bring the bigger asset there into production, then our royalty interest will be extremely interesting assets and very good for us. But it's certainly better to have the iron ore floated out rather than in Jupiter, which is concentrating on keeping its return to shareholders up, and therefore not making big investments in ancillary assets, and which is therefore not putting a lot of money into the iron ore assets. And we have a huge interest in seeing those iron ore assets develop because of the royalty. So we've got those two things. I don't know how much our interest in Juno is going to be worth once it gets floated, but it's going to be, certainly to start with, it's going to be in the hundreds of thousands of dollars. And then we, with Power Metal Resources, we invested in that at the beginning because we saw that it's the metals it was going to be investing in or had been investing in were complementary to ours, took us further into the battery metals sector, which we liked at the time. And so we have, with Paul Johnson, who was an old shareholder in Red Rock Resources and who we cooperated closely on Greatland Gold, changing the direction of that. And now we're cooperating in Power Metal Resources. We put in $100,000 there, and it's now worth £100,000, I should say, and it's now worth whatever it is, $1 million, and can go much higher. So between those assets, we have, and the cash we're holding, we're saying we think it's sort of 4 million plus, but we really want to get that to 5 million in reserve so that we are using our dividends and royalties that we receive from the gold assets in Colombia to meet a lot of our normal administrative costs and keeping a good reserve so that we can do our exploration programs and we don't have to worry too much about the market, and the market doesn't have to worry too much about us. But as we float off some of our assets, as we hope the Red Rock Australasia, the gold exploration in Victoria later in the year, and some other assets that we have at least another couple that are sort of talking about floating off, then we can build up that cash reserve, or if it's not cash, investment that can be converted into cash. So we'd like to see that cash and investments get much nearer our market capitalization at the moment. And that will enable us to take the next stages of exploration. Because when you're exploring and trying to develop an asset, and if you want to retain the value of the work you're doing, then you want to put off the day when you have to perhaps bring in a partner and where you have to sacrifice some of the value, the future value. And you want to be able to cycle through the stages of exploration as far as possible yourself, bearing in mind that each stage of exploration is considerably more expensive than the stage before. So we have, as part of our strategy from now, we want to be and remain a liquid company.
Okay, Andrew Bell, the CEO of Red Rock Resources, thank you very much.